Good morning, everyone. Welcome to Dollars with Cents. I'm Terrence Vanderwood.
And I'm Ella Lange. Hello. We're back this week for another great Q&A session, questions and answers around downsizing. As you know, Terrence and I, your two financial gurus, have been covering this important topic with you for the last 3 weeks, just because there's so much information we want to share with you on a variety of levels. What to think about when selling your house and buying your new home, or how does one pack up and move? Or what can one do with the leftover capital from the sale to sustain a healthy and comfortable retirement? George and Barbara Walker, our case study clients, allowed Terrence and I to share with you their transition so that perhaps some of you out there could pick up helpful tips if and when you too embark on this journey.
As we have a few questions arise from our last 3 episodes, we thought it would be fun if we had some of the professionals we work closely with if we had some of the professionals we work closely with clients who are downsizing answer some of the questions themselves. Kim Farquhar, a certified relocation and transition specialist, provides helpful logistical tips, and Michael Hallet, mortgage and refinancing expert, addresses some common misconceptions and objections around reverse mortgages, which is one of our questions.
I think we had a couple of questions around investments too, Terrence, but we'll try to get to as many as we can. This is going to be really cool, so get comfy and turn up the volume. You're listening to Dollars with Cents.
Welcome back to Dollars with Cents. I'm Terrence Vanderwood. You'll remember in part 1 of our series on downsizing, we talked about some challenges seniors face when undertaking a downsizing project. Kim Farquhar is the founder and CEO of Siller Valley Transitions, a full-service transition company that will manage all details of a move from day one through to until you're settled in your new home.
A question Kim is asked the most is, what do I do with all my stuff? Inevitably, moving from a house with 4 bedrooms, a basement, den, garage, and so on, to a condo with 2 bedrooms, or perhaps a retirement home, presents quite a challenge, and as Kim explains, there is not an easy answer for that. What we usually do is sort through all the possessions and divide them into 5 categories. To keep, so those items moving with you, gifts, items that a friend or family member may like or has requested, sell, items that would go still for a profit, donate, items that are still in good working order but would not be worth selling, and trash, items that are broken or damaged.
Including with that trash is, of course, the ones that you go for recycling, right?
Oh,
of course. Kim explains, deciding which items go into each category can be quite difficult and can bring forward a lot of emotions such as guilt and sadness. It is often difficult for seniors to accept that items that they spent money on and have truly treasured over the years are not wanted by family members. Sometimes they are not even able to sell them themselves. Sadly, the market on good used furniture is very limited. Auction houses and even many charities are not interested in large furniture, and the only option may be to sell through local websites like Craigslist or bidding sites. We always warn our clients of using these sites on their own because of the dangers involved. When sorting through the possessions, we decide how much can be kept using basic math. If you are downsizing from 4,000 to 1,000 square feet, you will need to get rid of approximately 3/4 of your belongings. We also consider where you are moving to. If you are moving to a retirement residence where you are not having to cook or clean, we can reallocate the majority of your kitchen items. Each move and situation is very unique, and therefore we design a move plan based on the needs of our clients. No 2 moves are alike.
That's great. I can't believe that, but that's so sad about the furniture. I would take in all my parents' furniture with pleasure. If you have more questions or concerns around the logistics of a downsizing project or just decluttering, any other helpful tips concerning your pending move, we encourage you to check out www.silvervalleytransitions.com, where you'll find a way to read more about their services and or organize an appointment. They're ready to help.
In part 2 of our series on downsizing, the next question that somebody brought forward was about reverse mortgages, which is a special type of loan for older homeowners, 62 years or older, that requires no payments as long as one applicant lives in the home. However, payments can be made if they wish. It is the only mortgage in Canada where payments are truly optional. No medical is required, and there is limited income and credit requirements. Clients can receive up to 55% of the value of their home in tax-free cash, depending primarily on their age and property type and location.
There's been a lot of mixed commentary on the reverse mortgage market. Michael Hallet, mortgage expert, addresses some of the common misconceptions and objections. For example, one comment we received was, "I heard they were restrictive and bad for seniors." Well, Michael writes, much of the negative press around reverse mortgages originated out of the US, where the programs have been run much differently. The rates, fees, and restrictions are quite different from Home Equity Bank in Canada, a chartered bank since late 2009. Since becoming a Schedule I bank, the costs improved, and Home Equity Bank has tailored their product to be more like a credit line, but with completely optional payments. They partner with every major bank in Canada, most credit unions, and with mortgage brokers. These institutions wouldn't partner with a lender and send their clients to a lender that was offering a program they didn't believe in or feel comfortable with.
Another concern is that the bank will own my house. Well, Michael Hallett's answer to that is this is only a mortgage, so title remains 100% in the client's name. They will not be asked to move or sell or make payments for as long as there is at least one applicant that lives there. They leave on their terms.
I'll lose my equity. What about that? So Michael answers, the maximum they lend is 55% of the value of the home, and the average advance is more like 35% of the value. This leaves quite a lot of equity as a cushion. If the real estate market increases at an average of about 2% or to 2.5% per year over time, which is inflation, clients will find their home value increasing just as much over time as the balance owed to Home Equity Bank, leaving plenty of equity in the end. After 30 years in business, their average client still has more than 50% of their equity left at the time they leave or sell.
And the Home Equity Bank also provides a guarantee that the client will never owe more than the fair market value of the home at the time it is sold. Thank you, Michael, for your insights. Check out his website at www.hallettmortgage.ca. That's HALLETTMORTGAGE.ca, where you can read his blog and find his contact details. We're going to take a short break and continue with more questions and answers here on Dollars with Sense.
Welcome back to Dollars with Sense. We're on a roll with some fantastic questions and answers. Terrence, give us another one.
What is going to happen with the real estate market in the Lower Mainland? Very interesting question. Good one and a top of mind probably of everybody right now. But I don't have a crystal ball, and neither does anybody else in the world. So this is the usual answer that you get from most realtors. The logical way of looking at it is that this is a market like any other market on the stock exchange. And like all markets, there are highs and lows. The Lower Mainland right now is in quite a high position. One could almost say a bubble.
As with all markets, it has to correct itself because that's how it works. So at some point in the future, the market will correct itself. To say that the real estate market is in a bubble and will pop is not the way I think it will play out. We only have historical data to make these projections. So like everyone else in the planet, this is our opinion and guess. And certainly Vancouver is in a unique position as it is a beautiful city. Of course, the dollar is low right now, and economically, it's doing very well, the best in Canada, in fact.
Yes, that's true. The best province in Canada. Our prediction is that we don't believe the real estate market will pop like the tech bubble popped in 2000. I believe the only event that could possibly cause this kind of market condition in the Lower Mainland would be like a very large earthquake or something of that, sort of catastrophic event. What will most likely play out is that the market will come to a height and flatline for a long period of time. In other words, the increase of the value of the house at some point in the future will be gaining a 0 to 1 or 2% for a decade or more. Again, this is from my experience as a real estate investor personally for the past 15 years, but I don't have a crystal ball, and nor does anyone else.
So let's move to another question. This one is about, this is a legal question. How much does it cost to have a will put in place, Terrence?
The lawyer on our downsizing team answered this by saying, as most lawyers are compelled to say, well, that depends. Having said that, the usual range of cost that is set up for your will is between $1,000 and $1,500. Of course, this depends heavily on how simple or complicated your will is. Everybody has different needs and different situations. So for it to be the most effective, it is best to be a tailored fit.
Yes, and in my experience, I find that finances are much like fingerprints. We all have them, but each one is unique to each individual. And that is the same when it comes to the property you own, from that nice painting you have on the wall to the real estate that you own and all your other assets. I hope this answers this question. Yeah, let's get to our last question. You mentioned corporate class on your last show. Can you elaborate on that, please? Terrence.
Yes, certainly. Corporate class structure is an investment portfolio with Investors Group that gives one the freedom to rebalance investments without incurring an immediate tax liability, normally triggered by switching between funds. If you're thinking of retiring and you've been in a moderate risk profile for many years, or for however many years, at some point you'll probably be switching to a more conservative asset mix to generate steady long-term retirement withdrawals. But that could create an immediate tax liability.
Essentially, corporate class provides the benefits of a tax-deferred compound growth, much like registered retirement saving plans or tax-free savings accounts, but without the traditional age barriers and annual maximum contribution limits. In other words, tax-free savings account has a contribution limit for 2016 of $5,500, and since 2009, a total contribution room of $46,500. That's your maximum investment there. For RRSP, for each person has their own limit, which you can find out by checking your notice of assessment. We've discussed that before. The amount is based on 18% of your annual earnings, or a maximum of $24,000 annually.
Rebalancing inside the corporate class structure doesn't trigger an immediate taxable capital gain because any monies beyond the RRSP and the TFSA maximums, those dollars go towards your non-registered accounts where there are tax implications, as stated before. Within corporate class, you can defer 82% of these tax implications to your estate. In other words, you are deferring the bulk of your tax bill until the day you pass away. That way, the tax money that you defer has a great chance to grow. Take a look at the chart on your screen right now. If you can't see it, then please go to the podcast where it will be on the 18th episode, and that's on our Facebook page of Dollars with Cents. And you can see the screen coming up. For those of you who are listening and don't have the screen in front of you, what it is I got two pie charts here. One is a possible pre-retirement investment, and the other is a typical post-retirement investment mix. So during pre-retirement, when you don't need the money, 80% of it goes towards equity, which is a little bit riskier investments, and 20% go into fixed income, which are conservative investments. And when it comes to post-retirement, then that split should be rebalanced because you are going to be relying on the income that's there. So we want to protect the capital. So we split the mix to 60% equity, so you're still earning a good rate of return, and 40% are in fixed income, so it's in a conservative place so that when you need the money, it is there.
That's awesome. Thank you, Terrence. This is exactly why you can rely on your financial gurus, Terrence and myself, for this type of smart financial planning. We can provide you with written plans to keep you on track with the growth of your wealth and management of retirement funds. If you would like more information or a financial review with no obligations or cost to you, please do not hesitate to call on us. That is what we are here for in your downsizing journey.
Great point, Ella. Very good. Thanks very much. We're just going to take a quick break here, and then we'll be right back to recap and give you your action items for Dollars with Sense. Welcome back to Dollars with Sense. I'm here with Ella Lange. My name is Terrence Vanderwood. Thank you very much for joining us today. We are coming to the close of this episode, our 18th episode, I believe. The last 4 episodes are actually all dedicated towards downsizing. So I strongly recommend, if you are just joining us now, or if you have further questions about that we may have covered already, go back and listen to those episodes because there's a ton of information in there. And if you decide to take action on any of that information, then as we said before, you can feel free to contact us. Use this as a resource. Use this as a place to get the answers to your questions. And you can contact us at twofinancialgurus@gmail.com, or you can call us at 778-879-0820. So what we talked about today, we had about 5 questions from people who had emailed in regarding specific questions around the downsizing journey, or their questions in the possible downsizing journey that they may have.
And a big thank you to our 2 experts who provided answers to some of the questions that were addressed in the last 3 episodes. Kim Farquhar, who's the CEO and founder of Silver Valley Transitions, and to Michael Hallet, a mortgage expert. Thank you very much, guys, for helping us out this week. You can certainly check out both of their websites, www.silvervalleytransitions.com, and Michael Hallet is at www.hallet, that's with 2 L's, 2 T's, mortgage.ca.
Thanks again to everybody else for participating within this, our downsizing team who have helped us out with a lot of these subject matters, and the specialists that we have here at Investors Group. I'd also like to thank you, the listener, for joining in and helping us out with your questions, and also for being there. I hope that we've been able to answer some of your questions. And again, if you have any further ones, please feel free to reach out to us on our Facebook page, leave a comment there, or you can email and call us, as we said before. So that's going to be it for today for us. Thanks again to Ella, my co-host, and to everybody at CKPM FM. And we will see you next week when we talk about vacations and how to save for vacations, as Ella said earlier. So thanks again, folks. And remember, may your dollars and cents be with you.